All right, I'm continuing with Statements of Adjustment, Chapter 24 of the text. Mortgages. The relevant considerations for the Statements of Adjustments are whether the financing is supplied by the seller or by another source, and if a mortgage loan is from another source, whether it involves new financing or the assumption of the seller's existing mortgage. These facts will determine where on the statements the mortgage financing will appear and what the final cash requirements or payment will be. New loan by mortgage company or other third party. A new loan from a mortgage company or third party is a credit to the buyer. Okay, so it's something that they own on the right-hand side credit column, and has the effect of reducing the amount of the balance due from the buyer to complete, because part of the cash is being supplied by someone other than the buyer. No adjustment would be shown on the seller's statement because the seller is not concerned with the buyer's arrangements for financing the purchase price. The seller's primary concern is how much he or she will be receiving in cash. The seller will receive the same amount whether the buyer pays all of his or her own cash or whether some of that cash is supplied by a lender. A borrower is normally charged the costs of preparing and registering the mortgage, and, where applicable, the lender will deduct these from the loan. One way of making this adjustment would be to enter the amount of the net proceeds of the loan as a credit on the buyer's statement of adjustments. When this method is used, the conveyancer will show the gross loan amount and the deductions on the side for disclosure purposes, but those amounts do not form part of the computations. Another method would be to show the gross amount of the loan as a credit on the buyer's statement with the associated costs shown as debits. Returning to our original example, we can add the following facts. The buyer has arranged a new first mortgage with Crown Bank in the amount of $50,000. The appraisal and administration costs total $250. The buyer's statement of adjustments will now appear as follows. All right, and so here's a diagram. Buyer statements of adjustments. So we got the purchase price. It's on the left column, debit, what they owe, $100,000. Right. Then the second line, we've got deposit paid. That would be in the second column. The right-hand column, credits, what they own. Gross mortgage proceeds from Crown Bank. That, or let's just say Royal Bank here. So that would go to right-hand column, credits, what they own, $50,000. Appraisal and admin, this is fourth line, appraisal and admin fees for mortgage. That goes in the left-hand side, $250 debit, so that's what they owe. Conveyancing fees, $250, so that's what they owe. And now, the balance due to complete, which we found out is the balance, let me just see it from the other page here, 24.8. The balance due to complete is really, this is the bottom of 24.8. Balance due to complete is really the total debits minus the total credits. Okay? Alright, so the balance due to complete in this situation is $40,800. So it's basically the debits minus the total credits. Okay, so the debits minus the credits. You got that? All right, so then on both the totals for debits column and credits column is $100,800. Now notes, number one, alternatively, the net mortgage proceeds, $49,750, could appear as a simple credit, but in that case, the conveyancer would indicate on the statement the gross proceeds and the items that were being deducted to arrive at the net advance. Note 2, there would be no charge to the seller's statement because the source of the buyer's cash, i.e. from his or her own pocket or from the bank, will not affect the cash proceeds of sale due to the seller. Now, let's talk about interest adjustment. There may also be an interest adjustment in the event a new mortgage is arranged. This may be necessary because the mortgage funds were given to the buyer on June 14th, for example, but the first payment is not due until August 1st. That is because if the buyer made a regular mortgage payment on July the 1st, and a borrower is always paying mortgage interest in arrears, that's an interesting statement. A borrower is always paying mortgage interest in arrears. All right, let's read that sentence again. That's because if the buyer made a regular mortgage payment on July 1st, the buyer would be paying too much, only having had the money from June the 14th to July the 1st. There are two ways the buyer could pay the interest adjustment for the interest accruing from June 14th to July the 1st. The lender could have the buyer pay it on July the 1st, or the lender could deduct it from the mortgage advance with no payment on July 1st, and the first regular mortgage payment being made on August the 1st. In the latter case, this interest adjustment would appear as a debit, something owing, on the buyer's statement of adjustments, reducing the gross mortgage proceeds and therefore increasing the balance due to complete. If the mortgage advance date is early in the month, the adjustment can be almost as much as a regular mortgage payment. All buyers should take this into account to determine the balance due on completion, but in the case of first-time high-ratio buyers, this may be problematic if they are working with tight budget constraints and are not expecting this upfront deduction. New loan by seller. Whether a seller take-back mortgage or an agreement for sale, a new loan by the seller is a credit to the buyer as it reduces the amount of cash due to complete, just as a new mortgage from a bank would. However, it is also a debit to the seller because it reduces the amount of cash proceeds of sale, since the seller has agreed to accept the amount of the loan by way of future monthly payments instead of all cash upon the completion. We can return to our original example and alter the facts as follows. Now this is a little blue section. Instead of arranging a first mortgage with Royal Bank, the buyer and seller agreed that the seller would take back a first mortgage in the amount of $50,000. All right, next page. The buyer's and seller's statements of adjustment will now appear as follows. Buyer's statement of adjustments. Okay, first line, we got the purchase price. It's in the left-hand debits column of $100,000, so that's what they're owing. Now the deposit, second line, that it goes into the credits column, so it's what they own. That's $10,000, so they basically already paid it. Third line, mortgage taken back by the seller. Remember, this is the buyer's statement of adjustment. Mortgage taken back by the seller appears in the credit section, what they own, $50,000. Conveyancing fees, that goes as in the debits left column, $550, because it's something they owe. And then the balance due to complete, which is debits minus credits, is $40,550. And the totals of both debits and credit section is $100,550. Now, here's the seller's statement of adjustments. We've got the sale price, that there's empty in the debits column on the left because it's not owing. It's not a bad thing for them. It's a good thing. It's in the credits column, $100,000. It's what they own. Now, the second line, first mortgage taken back by the seller. Now, because they're taking it back, it's a debit to them. It's something bad for them, negative. It's something owing, $50,000. Third line, real estate commission. That's also a negative thing for the seller. It's in the debit column on the left, which is owing. It's $5,000. And then the fourth line is cash proceeds of sale. which is basically a totaling of the, what is it? It is the, in this case, it would be the credits minus debits. Isn't that right? It would be, because let me see, in the buyer's statement of adjustments, it's basically the debits minus credit, right? Debits minus credit. Okay? And that comes the balance due to complete, which is always shown in the right-hand credits column, which means own, right? All right, now, but the cash proceeds of sale is on the left-hand side, the debits. It's a bad kind of thing. This is for the seller. This is 45 grand, which basically would be the total credits, which is 100 grand, minus the 50,000 first mortgage taken back by seller and the real estate commission, which these are things owing, basically, 5 grand, real estate commission. So that comes out to 45 grand. So that is basically credit minus debits. Wow. Now, there's a note in the bottom here. Because the seller has agreed to accept a mortgage loan as part of the purchase price, the amount of the mortgage loan is a debit to the seller. That's something bad, negative. It's in the left-hand side is owing. This is because the mortgage loan reduces the amount the seller would receive as cash proceeds of the sale. An agreement for sale would be treated in the same way. It would appear as a debit on the seller's statement as an amount reducing the cash proceeds of sale to the seller. Okay, now we're out of this diagram. Existing mortgage assumed by buyer. Where there is an existing mortgage on title before the sale and that mortgage will be assumed by the buyer and remain on title, the amount of cash due from the buyer as well as the amount of cash due to the seller is reduced. The real property section of the BC branch of the Canadian Bar Association recommends that where a mortgage is assumed by a buyer, the balance of the mortgage to be assumed should be adjusted as at the completion date rather than the adjustment date. That is because the amount assumed under the mortgage is really part of the payment of the purchase price required to be paid on the completion date. The buyer should assume responsibility for the mortgage payments commencing on the completion date. This recommendation should be kept in mind when the completion date is not the same as the adjustment date. For purposes of the examples in this chapter, assume that the adjustment and completion date are the same. We can, again, alter the facts of the original example as follows. Now, this is now the blue section. This is an example. Because there is an existing first mortgage registered against a title, it's not necessary for the buyer to arrange any outside financing. Instead, the buyer will assume the existing mortgage loan in the amount of 47 grand. Excuse me. The buyer's and seller's statements will now appear as follows. Okay, so now here's the diagram, buyer's statements of adjustments. So the purchase price on the left, okay, all right, I'm just gonna make some little diagrams here. So for the debits column, I'm gonna put a frown. And on the credits column, I'm going to put a happy face. Okay? And so here we go. The purchase price is the first line, 100 grand. That's in the debits column because it's owing from the buyer. Now, the deposit paid, it's already been paid, so it's a good thing. So it's on the right-hand side credits column with the happy face. They're owning it. Third line, assumption of the first mortgage. That's also a good thing for the buyer. So it's 47 grand. It's in the right-hand side, the happy face owning column with the credits. Now for conveyancing fees, because it's paid for by the buyer, partially, yeah? Conveyancing fee, no, it's all, they're paying the conveyancing fee. So it's on the debit column, so it's they're owing it. It's the negative, it's the frowning face. Empty in the credits. And then the balance due to complete is $43,550. So basically that's it's the debits, the total debits, which is $100,550 minus the total credits, which come out to be $57,000. So it comes out to that. And both debits and credits column, they equal out to $100,550. Now we've got the statements, seller statement of adjustment. So the sales price goes to be a credit, which is basically $100,000. So it's in the right-hand column, credits with the smiley face. It's a positive. And then the assumption of the first mortgage on the second line, that goes into a debit. That's a negative, that's owing. That's something kind of sad. Debit. Negative. So then third line, real estate commission, that's also sad. That's in the negative one. That's debit. $5,000. Cash proceeds of the sale basically are the credits, which are $100,000, minus the debits, which is $47,000, $5,000, and $48,000. All right. Or sorry, not $48,000. Don't include that. So it's basically $47,000 and $5,000. So that comes out to 50. So it's credits $100,000 minus the debits of $52,000. So it comes out to $48,000 as cash proceeds of the sale. And both columns, debits and credits, they equal out to $100,000. Notes, number one, because the buyer is assuming the mortgage loan rather than paying the whole price in cash, the amount of the mortgage loan is a credit to the buyer and reduces the amount of cash required to complete. Okay. It's a credit to the buyer. Okay. What is? The mortgage loan. The $47,000, but it's a debit to the seller because it's kind of a negative for them in a way. Number two, because the seller's obligation to pay the mortgage loan has been transferred to the buyer, the amount of the mortgage loan must be debited from the amount due to the seller on the seller's statement. Okay, now we're out of this diagram. Existing mortgage paid off or discharged. An existing mortgage will normally be discharged by the seller out of the sale proceeds. This doesn't affect the amount due from the buyer. The buyer is not concerned with what the seller chooses to do with his or her money as long as the title is cleared. The total cost of the discharge being principal, accrued interest, and any costs, including legal fees of the lender, shows as a debit to the seller and reduces the cash proceeds of sale due to the seller on the seller statement. The original example now has the following additional facts. Here's the blue again. While the buyer is assuming the first mortgage, there is an existing second mortgage in the amount of $22,000, which will be discharged by the seller. The fees payable to the lender to obtain the discharge are $150. Okay, I'm out of the blue. The buyer's and seller statements would appear as follows. So look at the buyer's statements of adjustment. So in the first line, the purchase price is in the left, the debit column with the frown, $100,000. Because they have to pay $100,000. The deposit paid is a credit, a happy face, because they paid it already. It's $10,000. Third line, assumption of the first mortgage. That's also in the credit column, the happy face, $47,000, because it's a good thing. Conveyancing fees, that goes in the left-hand column, negative for debits, because it's a frowny thing. And the balance due to complete, which are the debits, which $100,000 purchase price, $550 conveyancing fees, minus the credits, which are $10,000 for the deposit paid and $47,000 for the assumption of the first mortgage. So it's $100,550 for the debits minus $57,000 for the credits. That comes out to $43,550. That's the balance due to complete. Now we go to the seller statement adjustments. We got this sales price, which goes in the credits column. The happy face, $100,000. Second line, assumption of first mortgage. That goes in $47,000 in the debits column, in the frowny face. The real estate commission goes into the frowny face debits left column, $5,000. Discharge of second mortgage, that's $22,000. That is a negative. They got to pay that off. That's debit, left side. Lender's fees for discharge is $130 negative thing. It's in the left-hand debits. And then we add everything together. We go credits. So the seller does the credits minus the debits. So the credits is $100,000 minus all these other things. And it comes out to $25,870. Notes. Number 1, the fact that the seller will be discharging a mortgage from title will not affect the balance due to complete from the buyer. Number 2, because it is the responsibility of the seller to provide title as agreed in the contract of purchase and sale, the seller must pay any fees, including legal fees and any disbursements involved in clearing any extra charges, for example, mortgages, judgments, etc. from title. Such fees will appear as debits on the seller's statement, reducing the seller's cash proceeds of sale. Those fees may be payable to the lender or to the lender